Hello and welcome to today's video, where we'll be discussing equity investors and how they manage their portfolios, as well as their perception of potential risks. Equity investors are individuals or entities who invest their money in stocks or shares of companies. This means that they own a portion of the company and are entitled to a share of its profits, as well as voting rights in some cases. Equity investing is a popular form of investing because it offers the potential for high returns. The value of stocks can go up and down, and if an investor buys stocks when they are low and sells them when they are high, they can make a profit. Additionally, many companies pay dividends to their shareholders, which are a portion of the company's profits that are distributed to them as cash payments. Investors can buy and sell stocks through various platforms, including brokerage firms and online trading platforms. There are many different types of stocks, including common stocks, preferred stocks, and exchange-traded funds, among others. Each type of stock has its own set of characteristics and risks, so it's important for investors to do their research and understand what they're investing in. Equity investors also have different investment strategies that they use to manage their portfolios. Some investors prefer to invest in a diverse range of stocks to minimize their risk, while others may focus on a specific sector or industry. Some investors may also use a combination of strategies, depending on their goals and risk tolerance. It's important to note that investing in stocks carries some level of risk. The value of stocks can be affected by a variety of factors, including economic conditions, company performance, and even political events. This means that there is always the possibility of losing money when investing in stocks. However, equity investors can manage this risk by diversifying their portfolios, conducting research and analysis on the companies they invest in, and having a long-term investment horizon. By investing in a range of stocks, investors can reduce the impact of any single stock or sector on their overall portfolio. By doing research and analysis on the companies they invest in, investors can make more informed decisions about which stocks to invest in. And by having a long-term investment horizon, investors can ride out short-term market fluctuations and benefit from the overall growth of the stock market over time. Equity investing can be a rewarding and profitable form of investing for those who are willing to do their research and understand the risks involved. By diversifying their portfolios, conducting research and analysis, and having a long-term investment horizon, equity investors can manage the risks and potentially reap the rewards of their investments. When it comes to managing their portfolios, equity investors have different strategies that they use depending on their goals and risk tolerance. Some investors prefer to invest in a diverse range of stocks to minimize their risk, while others may focus on a specific sector or industry. One common strategy used by equity investors is called buy and hold, which means that they buy stocks and hold onto them for a long period of time, sometimes years or even decades. Buy and hold is a popular investment strategy used by many equity investors. The idea behind this strategy is that investors buy stocks of high-quality companies with a long-term outlook and hold onto them for an extended period of time, regardless of short-term fluctuations in the market. This is often referred to as a passive investment strategy because investors are not actively trading their stocks on a frequent basis. One of the main advantages of the buy and hold strategy is that it allows investors to take advantage of the long-term growth potential of the stock market. Historically, the stock market has shown a positive trend over the long term, with occasional dips and corrections along the way. By holding onto their stocks over the long term, investors can benefit from this growth. Additionally, the buy and hold strategy can be less stressful than other investment strategies, such as market timing or day trading. Because investors are not constantly monitoring the market and making frequent trades, they may experience less stress and anxiety related to their investments. Another advantage of the buy and hold strategy is that it can be more tax efficient than other strategies. When investors hold onto their stocks for a long period of time, they may be eligible for lower capital gains tax rates when they eventually sell their stocks. This can result in higher after-tax returns for investors. However, the buy and hold strategy is not without its disadvantages. One potential risk of this strategy is that investors may hold onto their stocks for too long, even when it is clear that the company is no longer performing well. This can result in losses for investors who hold onto their stocks past their peak performance. Another risk of the buy and hold strategy is that it requires patience and discipline. Investors must be willing to hold onto their stocks through short-term market fluctuations and resist the temptation to sell when the market dips. This can be difficult for some investors, particularly those who are more risk-averse. The buy and hold strategy is a popular investment strategy used by equity investors. It allows investors to take advantage of the long-term growth potential of the stock market, while also being less stressful. and more tax-efficient than other investment strategies. However, it requires patience and discipline on the part of investors and may not be suitable for all investors, particularly those who are more risk-averse. Another strategy used by equity investors is called market timing, which involves buying and selling stocks based on short-term market movements. Market timing is a strategy used by some equity investors to try to profit from short-term fluctuations in the stock market. Essentially, market timing involves buying and selling stocks based on the expectation that the market will move in a particular direction in the short term. Investors who use market timing may use a variety of different indicators to help them determine when to buy or sell stocks. For example, they may look at technical indicators such as moving averages, or they may analyze economic data to try to predict how the market will perform. The idea behind market timing is that by buying low and selling high, investors can earn higher returns than they would by simply buying and holding onto stocks over the long term. However, market timing is a risky strategy because it requires investors to accurately predict short-term market movements, which is notoriously difficult to do. One of the challenges with market timing is that the stock market is highly unpredictable in the short term. Even if an investor has access to a lot of data and analysis, there is no guarantee that they will be able to accurately predict which way the market will move. This can lead to investors buying stocks at a high price only to see them fall in value, or selling stocks too soon and missing out on potential gains. Another challenge with market timing is that it can be costly. Investors who are constantly buying and selling stocks may incur higher transaction costs than those who simply buy and hold onto stocks over the long term. In addition, market timing can be a time-consuming strategy that requires investors to constantly monitor the market and make decisions about when to buy and sell stocks. Despite these challenges, some investors continue to use market timing as a strategy. They may believe that they have a particular skill or insight that allows them to predict short-term market movements, or they may simply enjoy the excitement of trying to outsmart the market. Overall, while market timing can be a potentially profitable strategy for some investors, it is important to remember that it is a high-risk strategy that requires a lot of skill and discipline to execute successfully. As with any investment strategy, investors should carefully weigh the potential risks and rewards before deciding whether or not to use market timing in their portfolios. Now, let's talk about the perception of potential risks among equity investors. Equity investors are aware that investing in stocks carries some level of risk. The value of stocks can be affected by a variety of factors, including economic conditions, company performance, and even political events. One of the ways that equity investors manage this risk is by diversifying their portfolios. By investing in a range of stocks, investors can reduce the impact of any single stock or sector on their overall portfolio. This means that if one stock or sector performs poorly, it won't have a significant impact on the investor's overall portfolio. Another way that equity investors manage risk is by conducting research and analysis on the companies they invest in. This involves looking at a company's financial statements, management team, and other factors that can affect its performance. By doing this research, investors can make more informed decisions about which stocks to invest in. So there you have it, a brief overview of equity investors and how they manage their portfolios and perception of potential risks. Whether you're a seasoned investor or just starting out, it's important to have a strategy and a plan in place for managing your investments. Remember to always do your research and stay informed, and you'll be well on your way to building a successful portfolio. That's all for today's video on equity investors and how they manage their portfolios and perception of potential risks. Remember, investing in the stock market can be a great way to build wealth, but it's important to approach it with a plan and a clear understanding of the risks involved. Whether you prefer to use a buy and hold strategy, or market timing, or if you prefer to invest in a diverse range of stocks, always remember to do your research and stay informed. With the right strategy and a bit of patience, you can achieve your investment goals and build a successful portfolio. Thank you for watching, and we hope this video has been helpful in your journey towards becoming a successful equity investor.